And let's figure out where we left off on Wednesday. So we discussed the fact that, again, a long-term fixed asset, also called a plant asset, these terms are all used interchangeably, has sort of points in its life that have accounting implications. We discussed the fact that when we acquire one of these assets, we have to figure out what is the value of the equipment, the building, the land, whatever it is. And we have to consider other things than just the sticker price, right? Like how much was the sticker price plus a bunch of other costs that we may have had to incur to get this thing up and running, right? If it's a piece of machinery, we may have had to install it and test it. If it's a plot of land, we may have had to survey it for what we needed it for. If it's a building, we may have had to pay for the title to transfer to our business's name. All of these additional costs add value to that asset, right? And so when we consider what the asset's total value is, we have to take into account the sticker price, the original purchase price, plus all of these other costs associated with getting that asset up and running for its intended use. Then we moved on to sort of the second phase of the asset's life, which is when we're using it, right? And we said over time, we know that as the asset is being used, the value of it goes down, and we call that depreciation. We said that in order to calculate depreciation, we need three things. We need the asset's cost. We need the asset's salvage value. Can someone please remind us what salvage value is? Yeah, Trace. How much can you get out of it when you're done using it, right? The salvage value. And then what about useful life? Can someone remind us what useful life is? Yeah. How long are you going to use it? Not how long anybody can use it. How long are you going to use it? Okay. So we need the cost, the salvage value, and the useful life because we are focused on straight line depreciation. That means that we are essentially smoothing out the amount of depreciation that we take every single year. It's going to be the same. Okay. Straight line depreciation, but there are other methods. We're just not going to cover them in this class. We went through the same example under two different circumstances. The first circumstance was when we bought the asset on January 1. Nice and easy, right? Because then we know in that first year, we take a full year's depreciation. We took the asset's cost minus the salvage value divided by the useful life, and it got us an amount of $1,800 of annual depreciation. We accounted for the purchase of the asset itself, and then we accounted for the annual depreciation by debiting depreciation expense. It's an expense, which means it's a component of equity. It's always decreasing equity. That's why it's our debit. And then we made a credit to accumulated depreciation. Can someone raise their hand and remind us what kind of account is accumulated depreciation? Josh. Contra asset. It's going against, it's decreasing the value of the asset. And when we see that presented, because remember, assets go on our balance sheet. When we see that presented, accumulated depreciation, it needs to go right with the asset that it belongs to. So in this circumstance, we would see equipment, $10,000, and right underneath it on our balance sheet, accumulated depreciation, negative $1,800, because it's decreasing the value. That was the number one thing that students did wrong on their balance sheet on the midterm exam. And guess what? You're going to do another balance sheet. You're going to do another set of financial statements on the final exam, income statement, statement of retained earnings, balance sheet. And I want you to remember that these contra accounts need to go right with the asset that it belongs to in this case, right? And we also talked about the contra asset in chapter 7 with allowance for doubtful accounts. Make sure you're putting those in the right spot, and we will make sure that we practice those together as we get ready for the final exam. In our second circumstance, this same exact asset was purchased, but instead of purchasing it on, we don't buy all of our stuff on January 1, we bought it on October 1. And so we had to calculate the partial year depreciation. You didn't use it for 12 months, you only used it for 3, right? And so we had to take our 12-month depreciation and figure out the fraction of it that we had for that first year. 3 out of 12 was our fraction, okay? This was all a review of what we did on Wednesday. Does anybody have any questions about again, we're going to do more practice problems with depreciation, but for these examples, are we good? Any questions? Okay. So, I didn't get, did I get to that? No, I didn't get to that. Okay, I apologize. I should have covered this slide before we ended class on Wednesday. Depreciation, same as the allowance for doubtful accounts, bad debts, is an estimate. It's a guess. The accounting rules, yeah, I did. That was when we were talking about the salvage value. Yes, but we're getting to that. We're getting to the win-loss thing a little bit later. With calculations, depreciation, allowance for doubtful accounts, things that you estimate, the accounting rules say you're allowed to change your guess. If new information comes to light where you think, hey, instead of using this thing for 5 years, we're actually probably going to use it for 7. We're allowed to change our calculation. And in that useful life, we're allowed to put 7 instead of 5. It's going to change the amount of depreciation that we take that year, and that's fine. The accounting rules say, if you have a valid reason for changing your guess, change it. New information comes to light. You think you're going to use it for 2 more years? Change the calculation. You're allowed to do that, okay? There are certain circumstances where you have to backdate that change. You have to retroactively apply that change to past years. This is not one of those situations. We don't get into those kinds of situations until we are in the intermediate accounting classes, right? These situations where you're just changing a guess, you change it in the year that you have additional new information, and then you use that new information moving forward. You don't have to retroactively do anything. You don't have to make any past year's journal entries and change them. Change it in the year that you come up with the new estimate and use that new estimate moving forward. Okay, that's what this slide was about. Again, I apologize. This would have rounded out and finished our conversation about depreciation, that it can be changed. It's not locked in. And so what you would do is just adjust your calculation in the year that you have that new information and then use it moving forward. Make sense? Okay. Not sure I understand. Siri doesn't know. So another part of an asset's life could be that we have additional expenditures related to the asset, okay? We have a piece of machinery and we have to fix it, okay? Or we have a piece of machinery and there's this new part that if we purchase it and add it to the machinery, it actually improves how it works. It makes it better, okay? Those are 2 different scenarios that have to be accounted for in 2 different ways, okay? Now, I am not going to ask you to make an entry in a journal for these kinds of additional expenditures, but I want you to understand what the accounting implications are in each of those scenarios, okay? So let's take scenario number 1. Scenario number 1 is an ordinary repair. That means we are not improving that asset in any way. We're not making it last longer. We're not making it more efficient. We're not making it more productive. Nothing. We just needed to make a repair to get it back up and running as it always has. Does that make sense? That means we don't have any new value to our asset. We just have a periodic expense. We'll call it repairs expense or maintenance expense on our accounting records, okay? So if you make a repair to one of these long-term assets, and that repair does nothing to make it better, it doesn't make it last longer, doesn't make it more efficient, more productive, nothing. That only gets accounted for as an expense. And again, we would typically label it as repairs expense or maintenance expense, okay? Versus what they call an extraordinary repair. That means that you are purchasing something, you have an expenditure, a cost, and whatever it is that you're doing is actually adding value to the asset. It's going to make it last longer, or it's going to make it more efficient, or it's going to make it more productive. Whatever it is, that additional expenditure is adding value to your asset. That means that you have a new asset essentially. And you have to make an entry in your journal, not for a repairs expense, but for a new asset that you're adding to your balance sheet. Okay. So again, two different scenarios. We have to understand when we are making repairs to our assets. Is it an ordinary repair, meaning it's not improving anything? Then that would just be a simple expense that we would account for during the period that we made the repair. But if it is extraordinary, meaning it is something that is going to add value, make it last longer, make it work better, make it more productive, then that's a new asset. And you would account for that as a new asset on your accounting records. This next slide, again, gives an example of what we would do, okay? Ordinary repairs, we would debit the expense and credit cash, again, because we've had to pay for the repair. But if it's something that's adding value to the machinery, we would need to update the value of that machinery. Debit machinery, credit cash for whatever the expenditure was, okay? I will not on a quiz ask you to make these entries, but I want you to understand the difference between an ordinary repair and something that adds value because the accounting is completely different. Ordinary repairs, just an expense during the period that you repair it. If it's an enhancement, it creates additional value to the asset, then you show that as additional value to the asset. You debit the asset, okay? Any questions about this? All right. So we are getting to the last leg of our assets life, okay? So we talked about what are the accounting implications when we acquire a new fixed or long-term asset. What are the accounting implications when we have to use that asset? And so we depreciate it over the period that we're using it. What happens when we have these additional repairs? How do we go about accounting for that? The last leg of this asset's life, okay, as far as our accounting records are concerned, is when we're done using it and we have to dispose of it. So here's where we're going to talk about those wins and losses, okay? Disposing of an asset is going to have an impact in our accounting records. If you are no longer using an asset to help you generate revenue, remember, accounts receivable, inventory, supplies, land, buildings, all of these things we own and benefit from having. The way we benefit from having machinery, equipment, buildings is because it's helping our business run. It's helping us generate revenue, right? If we don't have a building to operate in, we can't generate revenue. If we don't have machinery and equipment building our products, we can't generate revenue. So these are all assets because they are helping us generate revenue. If you are no longer using that asset to help your business generate revenue, you need to get it off your books, okay? You need to get it off of your accounting records. And so the way that we are going to do that in general form is one, make an entry in our accounting records to remove the asset and the accumulated depreciation, right? We said that over time we depreciate this asset and we have this accumulated depreciation contra asset account. And it has all of the depreciation that we made to that asset for the whole time we were using it, right? That accumulated depreciation I told you is linked to the asset. It gets reported right next to the asset when we look at it on our balance sheet. So if the asset that it is linked to is going away from our accounting records, it needs to go away too. Accumulated depreciation has to be taken off of your accounting records as well. So the first entry we're going to make in our journal when we dispose of an asset is going to be, let's take the asset off of our accounting records and let's take the accumulated depreciation off of our accounting records. That's number one. Number two, we're going to record anything that we received, right? Because we said some of these assets have a salvage value. We may be able to scrap them or sell them or trade them for another asset. So the second part of our entry is going to be, what did you get? Did you get some cash? Did you get another asset? Maybe you got nothing. That's okay too. Then you just skip part two, okay? So part two is record anything that you received as you disposed of this asset. And then number three, did we win or did we lose? Okay. And for number three, what we are looking at is How much is that asset worth on our accounting records right now? We're going to call that book value. The value of the asset on your accounting records right now is called book value. And the way that we get book value is by taking the asset's value and subtracting accumulated depreciation. Okay? So if we know how much the asset is worth, and then we subtract out all the depreciation we've taken so far, that leaves us with, well, what's the value of the asset on our books? Book value. Are you with me? If your book value is more than what you got for that asset, you lose. You think it's worth $1,000, you only got $500 for it. You lose, right? And we'll talk about what that entry would look like in our journal. If your book value is less than what you got for it, you think it's worth $1,000, someone gave you $2,000 for it, sucker. You win. You got more than what you thought it was worth. And we're going to show how that gets reported on your accounting records as well. Okay. So number one, you're disposing of an asset, then get the asset and its accumulated depreciation off of your accounting records. Number two, show anything that you received. Okay. Did you get cash? Did you get another asset? What'd you get? Number three, if your book value is different than what you got out of this disposal, you may have a gain, you win, or a loss, you lose. Okay. So generally speaking, these are the steps that we're going to take. Okay. So let's look at our first example. In this example, our company currently has a machine that has a cost of $100,000. That's the original asset value, $100,000. Okay. A salvage value of $10,000 and a useful life of 10 years. We bought the machine on January 1st, 2016. Okay. It's now January 1st, 2021. We've been using the asset for 5 years. We thought, remember, our estimate was that we were going to use it for 10. We've been using it for 5, and we realized after 5 years of use, we can't use this thing anymore. This machinery or equipment has become obsolete in our facility. We're not going to use it anymore. So we have to dispose of this machinery. At this time, the accumulated depreciation of $45,000 is currently on our accounting records. Okay, and I'm going to show you how we got that when we jump into Excel. Our first scenario is, let's assume then we dispose of that asset and we actually get $60,000 cash for it. We sell it to somebody for $60,000 cash. Okay, that's our first scenario. Then our second scenario is going to be, let's assume the thing is kaput and we got nothing for it, zero, and how that's going to affect our accounting records. Okay, so let's go through scenario number one first. In your Excel spreadsheet, you will see that the third tab, oh, that's the wrong one. Hang on. You will see that the third tab over is our disposal of an asset tab. Okay. So here's all of our information. Asset has a value of $100,000, useful life of 10 years, salvage value of $10,000. Okay. Remember, I told you step one in this process is that you remove the asset and its accumulated depreciation. So we have to figure out how much have we accumulated of our depreciation so far after 5 years? Because we thought we were going to be using it for 10. We only used it for 5. Okay. So someone remind me from what you learned on Wednesday, how would we calculate our annual depreciation, the amount of depreciation that we take every single year based on this information? Jordan. The asset cost $100,000. So I'm putting that first piece in parentheses. So parentheses, 100,000 minus 10,000, close parentheses, divided by the useful life, 10 years. I get $9,000. Did you get $9,000? Okay. Now, remember, $9,000 is our annual depreciation. And we have been using this thing for 5 consecutive years. So what would our accumulated depreciation be after using it for 5 years? Or how do I figure it out? Trace. 9,000 represents 1 year that we depreciated it. Times 5. 9,000 times 5 gives us our accumulated depreciation. So I gave it to you in the problem, right? If you go back over to the PowerPoint, I gave it to you in the problem. I told you, you have $45,000 of accumulated depreciation for that asset right now, okay? But if it's not given to you in the problem, that's how you figure it out, right? How much depreciation did you have for 1 year? And then how many years have you been using it? The annual depreciation times the number of years. In this case, it was 5. Okay. So step 1, remove the asset from your accounting records and the accumulated depreciation that's related to that asset. So let's focus on the asset first. We bought a piece of machinery. Let's call it machine. What would you have done in your accounting records when you originally bought that machine? What would you have done in your accounting records? What entry would you make in your accounting records? Machine. Yep. Cash. Absolutely. So imagine that entry in your mind, right? If I put the asset on my accounting records with a debit, how do I take it off? How do I make it 0? A credit. So the first part of our entry is going to be credit machine 100,000. Does that make sense to you? We think about this in terms of a T account. I'm running out of room. Our machine was 100K. We just made that entry in our journal. Now it's 0. That's what we want. We're not using it anymore. Get it off your accounting records. Are you with me? Now, what about accumulated depreciation? Because if you get rid of the machine, then you got to get rid of accumulated depreciation. Every year that we make our entry for depreciation, what do we do to accumulated depreciation? Is it a debit or is it a credit? Say it again. It's a credit. So every year we made a credit. 9,000, 9,000, 9,000, 9,000. We figured out that that account is sitting with a $45,000 balance, and we know it's on the credit side. Because every single time, if you click over to the other tabs, every single time you make an entry in your journal for depreciation, the accumulated depreciation is a credit every single time. I need that to be 0. How do I make that 0? Jordan, debit it for 45,000, right? So if you know that accumulated depreciation is going to have a credit balance and you want it to be 0, just make a debit for whatever the balance is, okay? So the second piece of our entry is going to be a $45,000 debit to accumulated depreciation. What do you mean how? So we accumulated depreciation. Every single time we make an entry for depreciation, we're always making a credit entry. Are you with me? That's what we did on Wednesday. Every time we make an entry, we debit depreciation expense, and our credit is accumulated depreciation. So what we are currently saying is this machine that we are no longer going to be using has accumulated depreciation of $45,000. And I want to get rid of it. Because if I'm not using the machine, I shouldn't have any record of it on my accounting records. So the way that I get rid of it is just to make a debit for the same amount. Because if I make a debit for the same amount, what's the balance of that account? Yes. You're doing it to get it off of your accounting records. If you are no longer using the asset, it's going to go credit 100,000. Because you are no longer using the asset, the accumulated depreciation's got to go too. Yes. But the accumulated depreciation belongs with the machine. You can't depreciate a machine that you're not using anymore, right? So if you can't depreciate that machine any longer, then the amount of accumulated depreciation that you currently have needs to get wiped out too. Okay? Any other questions about the first two pieces of our entry? Obviously, we're not done because nothing balances yet. Okay? That's step one. Step two, what did we get? In the first scenario, what did we get when we disposed of our asset? We got cash, right? So debit cash, how much did we get? 60,000. Still aren't balanced. I'm gonna change this a little bit so I have more room. Okay. Step three. Did you win or did you lose? The way that we know whether we won or lost is by taking the book value of the asset. How much is it worth to us right now on our accounting records? In this scenario, our asset was worth 100,000 and our accumulated depreciation was 45,000. Yes? So what's your book value? 55,000. Okay, and I'll do that in Excel here. In order to calculate book value, you take asset cost of 100,000. You subtract your accumulated depreciation of 45,000, and that gives you book value. 100 minus 45. We believe, so what does book value represent? It represents the amount that you think that asset is worth. We believe, based on our accounting records, that this asset is worth $55,000. And some sucker just gave us 60K for it. Did we win or did we lose? Say it out loud. We win. We win.
Sorry,
Siri's confused with whether we won or lost. And I mentioned to you that we can't put win on our accounting records. That's not one of the names that we're allowed to use. But what we can do is say we have a gain. And typically there's a variety of different reasons why in accounting you could have a gain. So we want to be specific. I'm not going to be that picky on a quiz or an exam. If you put gain in the right spot, I'm going to be tickled pink. Okay. But normally we would put why did we have this gain? Okay. So what I'm going to include in my account title is gain on disposal of machine. I'm just going to be specific. If you just put gain, I am cool with that. Now I put gain right above revenue because I mentioned to you on Wednesday, that's what Isaac was referring to earlier. I mentioned to you on Wednesday that, yeah, you're agitated with me because I'm making you learn a new account, but gains are just like revenues. They add to our equity, which means gains are going to be credits in our journal. Yes? So, what is your gain? $5,000, right? Because we got $60,000 cash and we only think that asset's worth 55. We win $5,000. Okay. The key to making sure, I'm giving myself an extra space here. The key to making sure that you have done this right, do your debits equal your credits, right? Because that does not go away. Your entry has to balance. Even if there's 4 lines to it, your entry still has to balance. So I'm going to use my favorite tool, my little summation tool. to figure out my debits and make sure that my debits do equal my credits. And they do. Okay. Disposal of an asset. Any questions so far? Okay. Let's look at the second scenario. Let's assume same exact cost information, same accumulated depreciation information, but instead of getting $60,000 cash, we just had to get rid of this thing. We got nothing. Okay, nobody wants it. We can't scrap it, nothing. Let's go through our 3 steps again. Step 1, make an entry to remove the machine and the accumulated depreciation. It's going to look just like the first one, right? Our machine needs a credit of 100,000. That will make it 0. That's what we're trying to do. Make it 0. Make the balance 0. If it has a debit of 100,000, then you make a credit of 100,000. The accumulated depreciation, we also want that to be 0. It has a credit of 45. We're just going to make a debit of 45. That's it. Okay. So step 1, make an entry in your journal to remove the asset and its accumulated depreciation, both. Step 2, record what you got. What do we get? Nothing. We don't have to do anything. We got nothing. So step 3, our book value is $55,000. That's how much we believe this asset is worth on our accounting records. And we got 0 for it. Did we win or did we lose? Say it loud. We lost. Okay. And again, you have to introduce a new account. But what's nice about that new account is that it acts just like an expense does. Okay. So I'm going to include the new account name. And again, I'm going to be specific. I'm going to say loss on sale on disposal of machine. And if my book value is $55,000 and I got nothing for it, then my loss is $55,000. So that's going to be what I put as I lied. It's not in a credit. It's a debit, $55,000. And the reason it's a debit is because losses act just like expenses. And expenses always decrease equity. So that loss is going to be a debit in your journal. I don't know why I had scenario C down there. There was only 2. It must have been another time I taught the class. I had a 3rd one. Lucky you. There's only 2. Okay. Does anybody have any questions about this? Disposal of an asset. So this is the last phase of an asset's life on our accounting records. We are done using it. We have to make an entry in our journal so that it shows we're done using it. You cannot have an asset on your accounting records if it is not being used to help generate revenue. That goes for supplies, inventory, any of these long-term assets. If you don't own it and it's not helping you generate revenue for your business, it should not be an asset on your accounting records. Okay. And in this case, it was helping us generate revenue. It's just not anymore. Okay. Everybody cool? Okay. So I mentioned to you that a couple additional pieces of information that I wanted to talk to you about in this particular lesson were about other types of long-term assets that we haven't necessarily dove into very much yet. We've talked about we've made accounting entries and depreciation entries for automobiles and machinery and buildings and all these different kinds of what we would call fixed assets. They are like tangible assets that you're using to help generate revenue in your business. But there are also other types of long-term assets that don't fit into that category, where they're like tangible in nature and actively used in business operations. Natural resources is one of them. Yes, I guess technically it is tangible, something like oil, natural gas, you can't really see, right? But these are the kinds of things that we're talking about. If an organization is extracting natural resources and using those resources to help generate revenue, they would have those natural resources on their accounting records as an asset. So if you have a coal mine, if you have an oil rig, if you have, again, I'm not super familiar with these kinds of things in terms of the terminology, but if you are extracting natural resources and those natural resources are helping you generate revenue, that's an asset, okay? As you use those assets, you would account for the use of those assets similar to the way that we account for the use of a building or a piece of machinery or equipment. But instead of calling it depreciation, we call it depletion, okay? So instead of having depreciation expense, like you do for machinery, equipment, and buildings, you would have depletion expense for the use of the natural resources that you have extracted, okay? So same idea, same way to account, just a different terminology a little bit. Instead of calling it depreciation, it's called depletion. Instead of calling it a fixed asset, it's called a natural resource. Same idea, okay? Natural resources. And intangible assets. What was the intangible asset I mentioned to you on Wednesday? What? Trade name, right? Logo. Those are things that, yes, I can physically touch the Nike swoosh that's on my sweatshirt. But in terms of the nature of the asset, we would categorize that as intangible. It's not a fixed sort of plant type asset that you can lay your hands on. You can't lay your hands on the value of the Nike swoosh, but you know it has value, right? You can't lay your hands on the value of the golden arches, but you know it has value. Okay. Intangible assets, non-physical, used in operations. Oftentimes, they could allow an organization to have sole use over something. So think of like a pharmaceutical company, right? They get a patent for a particular drug. And that patent, not the drug is inventory, right? Because they're selling those drugs to hospitals and pharmacies and doctors and whomever, right? So not the physical drug, that's inventory, but the patent that allows only that one pharmaceutical company to produce that specific drug for a period of time, okay? They have the exclusive right to do that. Isn't that an asset? It's something that they own, and don't they benefit from having it? They're the only ones that are allowed to produce that particular drug for a period of time, okay? Same thing with like a copyright. So you look at your textbooks and they all have copyrights on them. That means that I cannot reproduce that material and put my name on it. If you notice, our PowerPoint slides all have McGraw-Hill Education on the bottom of them, right? Because it's copyrighted. I'm allowed to revise these things as an educator. I'm allowed to revise them and tweak them and use them in my course delivery, but I can't delete that and claim that I produced this because they have the right, the sole right to produce this material, a copyright, okay? Again, now a copyright is not something necessarily that you can like lay your hands on the value of it. It is an intangible asset, okay? We would, so some additional examples, franchises. So you can purchase a franchise. My husband and I joke all the time. We could have been millionaires a long time ago because at our old house in our old neighborhood, there was no drive-through coffee. We're like, why can't somebody put a Dunkin' over there? We should put a Dunkin' over there. Well, guess what? That Dunkin' has a line constantly because there's nothing else in the area, right? You can purchase a Dunkin' Donuts franchise, okay? And that allows you the right to use their logos and their products and their advertising materials. You don't have to recreate that stuff yourself. You get to use all of the corporation's pre-made materials, right? Pre-made advertisements in your facility. That franchise that you purchased is an intangible asset, okay? When we talk about intangible assets, again, we are going to account for them very similarly to how we accounted for our fixed assets. So any cost that it took for us to purchase the franchise, plus any legal fees, anything else that we had to pay for in order to get that franchise up and running, that would go into the value of the franchise. Anything that we had to do to get the patent for that drug, so we were the only ones that were able to produce it, all of those costs would go into the value of the patent, okay? And now, some intangible assets will have a useful life. Copyrights and patents are perfect examples. You are the only company that can produce that drug, but only for the next 10 years. Once the patent is up, it's fair game. Anybody can come up with their version of that drug and sell it in the marketplace, okay? So that patent would have a useful life of 10 years. And what do you think you should do to the value of that asset as you use it over that 10-year period? What should happen to the value of the patent? It should depreciate. But instead of calling it depreciation, of course, we have to make it a little bit complicated. We call it amortization. Okay? Amortization. So with fixed assets, buildings, equipment, machinery, we depreciate. With natural resources, it's called depletion. With intangible assets, it's called amortization. Okay? But the ideas are the same. You come up with the value of the asset and you show it being used over time. Yes. Well, the copyright for the audiobook would be the same kind of thing, but the audiobook itself would probably be inventory. If you've purchased the audiobook, that's the product that is being provided to you from the company. Does that make sense? Just like you would go into a store and purchase a book off a shelf. The books on the shelves are inventory to that store. Same thing if it's an e-store. The e-book that's on that shelf, it's inventory. You're purchasing a product from them. Does that make sense? But again, the copyright that's associated with it would still be considered an intangible asset. Okay. Any other questions about this? Okay. So what I would like for you to do in Moodle, in chapter 8, I will update because now we have finished our initial lecture problems. So I will update the Excel spreadsheet so you will have both a blank template as well as the solution. I want you to use those materials to jump into our chapter 8 additional examples, okay? And just like we did earlier this week, I'm going to give you, so there's about 20 minutes left of class before I would sort of make our final announcements and everybody's kind of heads home. For the next 20 minutes, I want you to get with your friends, and I want you to work on these additional examples. So if you open that up, you should see that there are 2 depreciation examples and there are 2 disposal of an asset examples. So you have the next 20 or so minutes, and actually I'll just make my final announcements now. That way, if you get finished with these, you would be free to go. If not, we'll come back and we'll spend maybe the first 10 or 15 minutes making sure that everybody's up to speed on these in class on Monday, and then we'll go through the solutions together. Okay, so final announcements. Chapter 8 homework, SmartBook and homework in Connect are due on Monday. You will not have another quiz in Moodle until we are finished with chapter 9. So we will begin chapter 9 probably on Monday and finish it up on Wednesday of next week. And then we will move forward with the next quiz that you will have. Okay. After we finish up chapter 9, like I said, I want to pause. And before we cover anything new, I want to go back and do a review of what we've learned in chapters 7, 8, and 9. That way it stays fresh in your mind when we get to the final exam, which is coming up in a couple of weeks. And then the other announcement I wanted to make is about your writing assignment. I am almost done. I have like 8 more papers to grade. So once I finish those up, I am going to say that at the latest on Tuesday of next week, I will have all of those finished up. I will send them back to you with my feedback comments. And then you will have until the last week of the semester to submit your final versions. Okay. Any questions about what we have going on? Okay. So raise your hand if you have any questions. I will circulate around, and we are just going to work on our chapter 8 practice problems for the next 20 or so minutes before class is over.